The basic manufacturing concepts are wonderfully simple. However, they have started sneaking in a few adjustments and so on just to make it a little bit more interesting the last few years. A statement of production costs is going to include all your costs of production, obviously. So you already know you've got your direct raw materials and your direct labor. These together are known as your prime or your direct costs. Last year, you would have just done them on their own as general ledger accounts. Now we are actually going to create a special little section for them in our manufacturing statement. Our manufacturing overheads will then be added to the prime costs to give us the total manufacturing cost. And the last thing that we need to do is then adjust for any work in progress at the beginning and end of the year. Because obviously, if you've got something that is not quite finished, it obviously is not part of your finished goods. And you can't use it as part of your cost of sales calculation. So can you see over here, all of these costs actually come from your work in progress account that you did in the general ledger. These are the figures that are going to be shown in your manufacturing statement. You can see the direct materials and the direct labor are added together to get prime costs. Manufacturing overheads are then shown after that. You'll very often have notes for these items. It is also possible to show them on the face of the manufacturing statement, but usually it gets a little bit tricky if there's a lot of numbers. So very often they're given as notes instead. And then you can see your total of your manufacturing cost, adjust for work in progress to give you the total cost of finished goods. Keep in mind that this total cost of finished goods equates to purchases in a periodic inventory system or inventory in a perpetual system. So instead of worrying about where you got the inventory from, where you bought it, you're now making it. And this is the amount that you will use as part of your cost of sales. Your statement of income will have a trading part and a profit and loss part. These parts can be split up into two statements or asked as two separate parts, or it could be combined in the entire statement of income, just like you've always had previously. Notice that the cost of sales calculation will be your finished goods at beginning plus what you produced from your manufacturing statement, minus obviously any finished goods at the end. It's your normal straightforward periodic inventory calculation that you would have done for cost of sales if you'd bought the stuff, except now you're just using finished goods instead of inventory bought. The rest of it is exactly the same. So now you've got to get clever because you need to make sure that you separate your manufacturing and your operating costs very carefully. Because as you can see in the statement of income, they each go to a different place. So your first question is it a manufacturing or an operating cost? Manufacturing means it's money that you threw at the factory. Operating means it's something to do with the shop or the office. Manufacturing costs, you need to split up into your direct prime costs, or is it indirect and then it's manufacturing overheads? Obviously, the prime cost is also broken up into your direct labor and direct materials. If it's not part of the factory and it goes into your operating costs, you would just show it as part of your operating expenses, which would be written off to profit and loss as usual. Adjusting expenses is important to understand how to do this. As I mentioned, a number of adjustments are creeping into the manufacturing questions these days. All you do is you make sure that you first do any adjustments. So if, for example, they tell you that rent was already prepaid at the beginning of the year, and at the end of the year, maybe there's an accrual, so you would need to add those items in. You'd then get the total amount for rent. And only once you've got the total amount for all the rent, then you go and you allocate it. I know it's very easy to think you only need to go and split up into the ratio the amount that you paid, but it's obviously not. You want to take the entire expense for the entire year. So that's how you do the adjusting of the expenses. Obviously, if you are a manufacturer, your inventory note is going to have a lot more information, because not only do you have your inventory that you normally have, you've now got inventory of raw materials, you've got inventory of your work in progress, and you've got inventory of your finished goods. Again, keep in mind that your finished goods would equate to your normal inventory that you would have had on hand, but now you've got your work in progress and raw materials extra. And that's how you do manufacturing. Keep in mind that when you are valuing your inventory, you need to use the lower of either the cost using FIFO or weighted average, or the net realizable value. You'll remember that this is exactly the same as what we did when we were looking at inventory valuation. It's the same concept. It's nothing different. It's just reminding you to keep that in mind when you are doing your valuations here also. Break-even calculations. This is a very important tool because it helps you to determine how many items do you need to produce and sell in order to not make a loss, nor a profit, of course, because break-even means there's no profit, there's no loss. It's just breaking even exactly. In other words, your total revenue equals your total costs. And the way that you can work this out easily is simply taking your total fixed costs and dividing it by the contribution margin. What do we mean by fixed costs? Well, obviously all the costs that don't change from your factory, but it's also your operating fixed costs. So if you've got fixed costs for your shop and your office, like your rent, your depreciation of your computers, etc., all of those costs would also need to be used here in this calculation, because you can't only use factory costs, because in reality, you're not then going to break even. You would only cover the factory costs. You also need to cover operating costs. The contribution margin simply means the difference between the selling price and the variable cost per unit. In other words, how much can each unit contribute towards covering the fixed costs? Sometimes they'll also ask you to do the profit, and then all that you do is you add the profit to the fixed costs and use exactly the same calculation.